Business of Property podcast. I'm Simon, and I've been investing in property for over 20 years. And if you're an active landlord or planning your next property investment, this podcast is for you. In episodes 271 and 272, I talked to you about the real costs involved in buying flats in various places across the country. One sort of shape and size of flats specifically. I chose 3 locations in the south, Croydon, Eastbourne and Plymouth, plus 3 that are more northerly, Manchester, Leeds and Derby. Do listen back to those episodes to hear the different prices of similar flats. They ranged from £125,000 to £350,000 to buy effectively the same type of flat, just in different places of the country. Similarly, the cash requirements to actually buy that property also varied a lot, from just over £40,000 all the way up to £113,000. That's a big difference in the amount of money and the amount of cash you would actually need to have saved up from a day job or similar. During those 2 episodes, I also looked a little bit at the likely rent for each of the flats, and from that estimated the possible profit and return on investment for them as well. Those return on investment figures ranged from just 2.1% all the way up to 7.9%, and interestingly didn't simply follow the purchase price. So that would suggest that the rental prices in the various locations are not always sort of in alignment in the same ratio with the purchase price. This week, I'm going to take a look at how time and capital growth might treat each of these investments. To help with this, I looked up the ONS house price data showing the changes in prices over time for each of the locations. And I'll tell you those results in a moment. But while I was putting together my spreadsheet to work this out, I noticed something else interesting. My spreadsheet started out simply assuming a 4% annual growth rate for all areas, just because I needed to put a number in the cell and I hadn't looked up the actual figures yet that I wanted to use. Now, as every purchase was based on a 75% loan-to-value mortgage, this should have meant that the capital-based return on investment worked out the same for all of them. But because there's a fixed amount of fees and a stepped amount of stamp duty included in the actual money that you have to put in, so that's the investment part of the return on investment calculation, it meant that when things were multiplied up over 20 years, that's actually enough to make quite a difference. So it turned out that the flat in Plymouth did worst based on this criteria, with only a 368% return on investment over the 20 years. Obviously not annual, that's over the 20 years. While Eastbourne managed to be in sort of the sweet spot of capital cost and fees and stamp duty, such that it managed to provide a 381% return on investment. The second worst was Croydon, only just above Plymouth, with 369% return on investment over the 20 years. Which I think is especially interesting because Plymouth was the cheapest flat to purchase and Croydon was the most expensive flat to purchase. So the difference in performance is obviously not related directly to the actual purchase price. There are other mechanics going on in these calculations as well. Of course, if you include rental profit, then Plymouth beats everything by a long way on this measure, with a total ROI of over 500%. Anyway, getting past that aside, I looked up the location-specific property price growth estimates for the last 12 months from the Office for National Statistics, so hopefully they're reasonable. Obviously, using historic figures is no guarantee of future performance though, and when looking over a 20-year time period, you could probably argue that all areas will end up kind of equaling out anyway. But that wouldn't be as interesting. I've gone for the last year's figures and plugged those in to see what we get. So you're aware, across our locations, those annual growth figures for 2024 were Croydon, 3.4%. This is growth in property prices in Croydon. Eastbourne was apparently a loss or a decrease of 4.2%. Now, this would have upset my calculations a bit, so I've actually excluded Eastbourne from the rest of these results, I'm afraid. So moving on to Plymouth, that was a 4.8% growth. Manchester, just 2.3%. Leeds, apparently storming ahead with 7.1% property price growth in 2024. And Derby was somewhere in the middle at 5% growth in 2024. Fairly obviously, the larger the annual growth, the larger the 20-year growth will be if we assume that it's consistent over that time, which is all I'm doing in my very, very simplistic model. So just to save you making a spreadsheet, these translate to the following 20-year return on investment. So this is total capital-based return on investment over the 20 years. So it's obviously not annualized or anything, it's just over the whole 20-year period. So for Croydon, 294%, Plymouth, 180%, Manchester, 181%, Leeds, 929%, Derby, 520%. Now, of course, these are in percentages, so if you're looking at pounds, things will work out very differently because the actual amount you started with, the investment amount you put into each of these, varies a lot. So, for example, Croydon is 294% on £113,000 of investment, and Manchester is only 181% on just £95,000. Lower growth and, sorry, I should say lower return and lower investment in the first place. So definitely not looking so good for Manchester. Now, these aren't actually very meaningful. And just to emphasize that the annual growth rates I've used are very unlikely to stay consistent for 20 years. If they did, these would mean that the flat in Leeds ends up being worth £30,000 more than the one in Croydon. From a start of the Leeds flat being about half the price of the one in Croydon. So I think that seems to be quite an unlikely result, just sort of on a basic sense check. So my point in working this out is to show that even the worst performing capital growth location, excluding Eastbourne, because, well, that didn't go so well, provided a total 181% return on investment over 20 years. So if you annualize that, that's about 9% per year, which is higher than the best of the rental element of the return on investment, which was 7.9%. So in conclusion, after lots of numbers and a big spreadsheet, over 20 years, even with just a 2.3% annual increase in the property value, and thanks to having mortgage leverage, which we don't extend in this example, so the amount of the mortgage actually stays consistent over the 20 years, the real money is made with a 9% annual return on investment from capital gains in the property. And if you were to find a magical location where property prices consistently increased at 7.1% per year for 20 years, you'd end up with 46% annual return on your initial investment. So hardly surprising that such a place can't really manage to exist. So that's all for this week. I hope you've enjoyed these numbers in a slightly quirky look at capital gains, and I will speak to you again next time.